Wow, this is a huge crowd. This is pretty impressive. Usually like half the people, so gets the nervous factor going here. But I'll throw the nervous factor on to all our panelists. So if everyone can just give a little short introduction, start with Marco.
Marco Baggioli, I'm the global head of brokerage at ADS Securities based in Abu Dhabi. We are a retail brokerage and institutional brokerage house located in Abu Dhabi, headquartered in Abu Dhabi, with an FCA regulated entity here in London, as well as an Hong Kong regulated entity.
Yes, my name is Mark Berkey. I'm the CEO of Swissquote Group and Swissquote Bank. So as the name said it, we are a bank since 2000, regulated by FINMA. We have offices in Hong Kong, Dubai, where we have licenses, and Malta, London. And we're doing retail FX, institutional FX, and trading of securities.
Hi, I'm Drew Neve. I'm the CEO of FXCM. And I don't think anybody needs too much of an introduction to FXCM, so I won't bore you with it. But I think obviously at the show, we focus mostly on our institutional business, so primarily everybody knows we are a retail trading house.
Hi, I'm Christian, CFH. What a timing to be on a panel like this. I had a very long weekend, and we finished everything on Monday morning. People did ask me, did you plan this? We actually didn't plan this for the Forex Magnates, but I think in relation to Michael and what you guys have done here, this is a tremendous event, and it keeps growing, so congratulations on that. But very excited to talk about what we're doing in the past and also what we're looking to do in the future.
Hello, I'm Tom Higgins, and I'm CEO and founder of Goldeye. We are a pure fintech company providing technology to brokers around the world.
I'm Anthony Bracco. I'm CEO of Advanced Markets. We're a prime broker dealing only in the institutional space for FX, CFDs, metals, and energies.
Thanks. Before I start, Michael, where are you there? I saw you walking around before. So I want to give everybody should give a big hand of applause to Michael Greenberg. Putting this. Are you showing it us? What? I wanted him to do the panel, but he's probably the most humble person in the entire industry, so he likes being on the side. So, this is calling this a CO panel. When it first came out, this was the Brexit panel. Then I got an email, it became the Trump panel. And then yesterday, it became the M&A panel. So, what do we want to talk about today? Let's start with Trump. One of the things that one of the people that care about it in terms of Trump is the things he said was that he wanted to repeal a whole bunch of different things. Among that list was he wanted to get rid of Dodd-Frank. So I wanted to start with you, Drew, in terms of, is that something that's going to actually make a difference specifically for the US in terms of the Forex industry, or just in general for the entire trading industry if regulatory changes, if Dodd-Frank is taken away and something else replaces it?
Yeah, no, I think it's probably the biggest sea change for the financial services industry in 10 years, since the financial crisis. Okay, if you look at two pivot points, the pivot points against the financial industry being the financial crisis, this is a pivot point that's huge because the United States, if it changes the regs pretty aggressively and deregulates, there's no way the rest of the world can just sit there and sail their ships the other way. And I think that that's going to be a pretty sizable impact. I mean, for us, if we repeal Dodd-Frank, that's probably $5 to $10 million of savings a year, and for FXCM. And if you look at, though, from a philosophical perspective, regulators have been emboldened more and more, forgetting the exact regulatory rule, because they just make it up as they go along for the one objective. Now, that one objective is to lay blame on the financial services industry for all the world's ills, and essentially create press releases that say, we find this person, we took this person out, that type of stuff. If that stops as a mentality, right, or is lowered down as a mentality, that's a global, it's the United States, it's not any country, and it will have a global effect on the entire industry. I think FX specific, there's not going to be any obviously specific changes, but I think that they're, just for FX, nobody thinks about us in that sense. But I think that having that environment be the new environment will affect us the most positively because we've been the most negatively impacted, from the other side.
Well, if he can get it done. I mean, I'm the other American on the panel. So if he can get it done and repeal, I think it'll be great for the industry as a whole, not only from the Dodd-Frank bill, but also the CFTC. Because you can get more conservative people running the CFTC, they certainly loosen up on some of the regulations that have basically hampered, basically all of us in the industry. So the CFTC to me is a big thing in changing the organization there.
So just, yeah.
Yes, well, I'm the Swiss guy here on the panel. So, and as you know, I mean, Swiss banks have had some history and some issues with the US, and
You probably want to get rid of FACTA, right?
yeah, well, there's FATCA. There's a lot of things. There was the famous US program to regulate the Swiss banks. So it's fair to say that the Obama administration was not that great for Swiss banks. So, but actually it started under Bush. So I'm not sure actually whether the US will ever stop to try to regulate the entire world financially. So I would like to be positive, but let's see what Trump will do.
Okay.
Yeah, just we take a slightly different stance because obviously being a tech company and not a liquidity provider or a broker, it's a bit different. The thing that we see about the States is there's such entrepreneurial spirit there, which is completely squashed in the retail space, the retail FX space. So if this does happen, then I think you'll see a lot of companies starting up there. I think there's a lot of interest there that's been suppressed over the years. So it'll become more competitive, which is very interesting for the market.
In terms of just back to that with Trump and also with Brexit, so this brought up political volatility for the first time. In terms of I was curious what Tom, what you and Chris are seeing from your clients, because you have a whole wide range of clients you're dealing with. How was their mentality in handling like the political changing landscape with volatility? Something they were aware of, some cared, some didn't care.
Well, I think in general, as I said in an interview with you guys, I think the industry was very well prepared this time around. The switch came as a massive surprise. And this time, I think everybody had enough. Okay, let's prepare. So everybody was sending out, we're changing margin rates. Everybody was being more careful. And that's what we saw from our clients as well. There wasn't this, we saw tremendous amount of trading right after Brexit, and then it kind of died out. Frankly, up to the first 2 weeks leading up to Brexit, as soon as you start changing margins, people were being more careful. As the banks came in, we also came in, and actually we had a good day of trading right over Brexit, but it kind of died down. And only when the margin changed again, it kind of picked up, and we saw a similar pattern with Trump. I mean, leading up to the events, we changed the margin rates. The clients were more careful. They understand what we're trying to do. Over the election, we had a lot of volatility, but actually it was actually, I think, quite well done for the industry as a whole. Everybody was very careful, and I think that also helps in the regulators' eyes that people not blowing up one after each other, like we saw with the Swiss franc. Of course, there's a massive difference between having a surprise event and then having something which is announced. But I think people are learning, and I think you have Italy coming up very soon. I think we're going to take the same stance there.
Okay. Mark, I'm curious to hear from you, because you also at ADS, you provide liquidity for CFDs, so not a lot of providers are doing that. Mm-hmm. And specifically, after Trump looked like he was going to win, so there was a lot of CFDs specifically were all over the place. And what did you guys do in preparation, or did you just cut things down? Or?
We debated a lot the issue whether to raise margin or not, and the question with raising margin is, in this situation, is how much do you raise them? Because we have seen at the time of the SMB, one of our competitors increasing dramatically the margin, 3-4 times. Still, the move was 3 times that much, so it didn't really help anybody. It contained a little bit, if you wish, the problem for the broker, but it was still a big problem. For us, it was more like education of clients, speaking to them and making them understand the risk of leverage, of a very high leverage in those situations, and the preparation with clients. We saw that lots of our clients there was lots of trading before and after, but everybody went in very cautious on the day. And again, as it was said earlier on, this is not like the flash crash a few weeks earlier, an unexpected event. Everybody's planning around it, and everybody's learning how to deal with this situation, one after the other. I think the flash crash was much more topical to clients than eventually the election has been. And the Italian referendum will be very similar in that respect.
Yes, I'm absolutely agreed. The political volatility when it's planned actually is not an issue. Like an election, for instance, everyone is getting prepared. The LPs are getting prepared. We are discussing with the clients. So basically, nothing happens. But there are a lot of political events that are not foreseeable, like a coup d'état somewhere in a country, or like any flash crash, as you mentioned. So my fear a little bit is that those major events like Trump elections actually are triggering those unforeseeable events, like a flash crash, because the flash crash happens because of Brexit, right? So we may have similar situations suddenly on the dollar, simply because people are starting to get frightened of any.
So basically, you think the planned issues people can prepare for, but that creates multiple little ripples that they probably won't see in the future.
I disagree. The sense that clearly one political event creates ripples in political event. That's true. I think, though, the sterling collapsing on 7 p.m. New York time, 6%, and it's 10% in an instant, right, and kind of ending down 6%, is a function of the regulators destroying the market, the wholesale market. And
Why?
I think
What does that mean?
because it's a function of the regulators taking out the risk takers out of the market. As the markets are going down, there's nobody stepping in.
Yeah, but you're always going to have limited, depth after a certain amount. I mean, it doesn't matter if it's.
If you look at the amount of time, look at gaps in the market, not even just when big events happen. If you look at the amount of liquidity in it, the amount of risk that's being taken, and we're not just talking about the immediate market makers. When market falls a lot, you have people that are not market makers, are hedge funds that would get in. Those people, nobody's in because people are afraid to get prosecuted because they're supposedly traded on insider information. People are afraid, to trade. This is a fact, and it's not just in FX. We saw that in the winter, of this year in fixed income. We see that in a lot of other markets. I think this is something that, if regulations are rolled back, because of the election, I actually think, and potentially because of Brexit too, right? Because if the UK kind of leaves the EU orbit, on the regulatory front, I think you're going to see a much more stable financial services industry, not the other way around. And I think if you look at stock market movements, that's what they're predicting, right? Everybody predicted gloom and doom for Trump. Everybody predicted gloom and doom for Brexit. Didn't happen. Right, the indices are all higher, the economies are better because the markets foresee the future, and the future is brighter in a less regulated world than a non-regulated world, and it's not meant, as a political discussion, but for our industry, it is the one biggest danger for our industry is overregulation, right? And I think if you look at it as a seminal event, can't be ignored, that this is the most positive thing that could happen to it, and all of the flash crash, the sterling flash crash, those have proved the fact that it's needed.
I want to get back to what you said something very important about how it was the lack of depth, and you believe there's a regulatory issue. But Tom, you wanted to add something.
Well, it's just with planned events and unplanned events, we have seen quite a change of requirements from retail brokers. I mean, so we've got about 150 clients around the world, and a few years ago, probably 3 or 4 years ago, the demand for risk management systems was lower than liquidity management systems. But now, today, it's probably the number one thing that people are asking for. So there has been quite a change in the way brokers manage risk. Well, I'm saying the smaller ones often didn't really manage it at all. They just hoped. Nowadays, it is a bit different. They're all asking for it, which is asking for risk management systems, which is a good thing. So when there are unplanned events happening, they're more prepared than they were before because they know their positions, they know their risk that they didn't know before.
You're adding in interesting points when it comes to how brokers are typically more prepared to handle the volatility. In the past, though, volatility was that's what everybody wanted. You made money when there was a lot of volatility. Does that mean that since companies are doing more of the risk management and they're preparing themselves for certain events, does that mean that they're limiting their upside as far as what they can actually profit during these volatile periods?
To a certain extent, they're limiting their upside, but the downside they're controlling. So by actively managing what they're warehousing and what they're covering in the market, they've got a much better quality of earnings because it's much more predictable what they're going to get. So a big change isn't going to kill them immediately. If they're a 100% B-book shop, they could make tons of money, but they could also go bust overnight. So they can sleep better.
Okay. Mark, what are you saying on that?
Yeah, well, it's sure that that more regulation actually, or the self-control of the industry when has an impact on P&L. I can give you a small anecdote. Actually, the S&B event costed us 25 million, 20 million. And the next day we had to go to FINMA to explain actually what's happening. How can we lose 20 million? And I think what happened next is now they want us to have our opinions. They want us to prepare the future. They want us to have more risk control, and this comes to a cost of P&L. So I think the industry has changed, and we have become more careful, which is a given, and this is good news basically because probably more companies will survive over the longer term. So and the S&B event was crucial for this industry. It hurt. It's not good, but ultimately at the end we all will benefit from that. And I think the new events actually has been mastered because S&B happened before.
Leading into a little bit about M&A and consolidation. So you mentioned, Mark, that basically that the industry has changed, and the potential profits are being tamed compared to what they were in the beginning. Does that mean that now to actually enter the market, you have to be much larger, or you have to be more risk averse, or can you still be one of those, as you say, cowboy type of companies that's be coming in and unregulated, and just try to make as much money as you want as quickly as possible and get out? Is that something that still exists, or you have to only enter if you have a much longer term view on being in the market?
Yes, I think probably technology will be driven this business more and more. Of course, you can have very aggressive business models that will work, and companies making a lot of money out of that. But over the longer term, actually, what the real differentiating factor will be technology. And we believe that the companies that are able to master technology, that have a certain size, will be the winner ultimately in this industry.
I mean, in China, this does happen a lot. So people come in, they've got a bit of money, they don't really understand the market, they don't have much money, they can license in all the technology, and then they can go and they can start working. But 20% of them go bust.
So China is basically where the Western world's FX in like 2007
yeah,
or something?
it's the Wild West, yeah. But it's maturing faster than we did.
Okay, I wanted to get Marco's opinion, because you deal with a lot of
my
with Asian
view is
companies.
that technology is very important, but at the same time, I think the regulatory environment that the company operates under and the capital to support the company is critical as well going forward. We have seen it, lots of companies that raise money from clients and mismanage those money, didn't segregate them, didn't handle client money, run away with money, never return them to investors. Investors are becoming much more shrewd about this, and we've seen it. If you look at the typical in China, the growing retail business, now they ask, before opening an account with anybody, where you are regulated, where is my money, etc. A year and a half ago, this was not even on the table as a question. So I think, to operate in this business, you will need to be much more solid an organization with more capital, more stability, more regulatory oversight, to provide your clients with the comfort that they will demand more and more.
So that would lead to some consolidation with some of the weaker companies leaving. A number of you have been involved with that, buying some of the weaker companies. Are you just a quick answer from everybody? Are you still seeing some of the people looking to get bought? Because I remember a couple of years ago, it was like everybody was trying to sell themselves, to try to exit the market because there was no volatility. So you're still seeing that? Right.
I think that, it's not just been a year and a half, right? The winners have been winning for a long time. right? And I think probably since 2010, since the easy days of FX, you know, kind of left us in 10, 11. I would say the bigger get bigger, the winners have been winning. That's been the case in every industry that's mature. This one is not an exception. You know, pre-S&B we bought, I don't even remember how many companies, and I think is the case that still lots of people do it. I think the regulatory environment makes M&A more difficult than it's ever been, because the amount of clients you have to throw out, right, that the person you bought doesn't have the same regulatory standard as you, and the legal repercussions of getting that wrong are now so high that I think M&A is chilled because of that. And the more the environment gets, you know, it's like it is in continental Europe, and you know, gets to be, you know, more around the world, the more you'll see a chilling effect on M&A.
Okay. So I've noticed that there's typically been very little small size deals take place. What, just adding to what you're saying there, is there a certain size that you need to be in order to be bought out? Like if you're this type of size of company, don't even bother because no one's going to want to take out of them.
It's a question of money you want versus how much money I could make from it, right? I mean, it's that equation can be $2 million, it could be $200 million. I think it's one of those things that, but the importance of how well regulated you are today versus 10 years ago, so I mean, how many of your clients I could actually keep, right, is now the critical, you know, element in that. And I
Okay,
think
so regulation is going to create a premium on the valuation.
I think from our point of view, we talked about consolidation for a while actually, and I think this was happening before S&B, but the S&B is actually pushing it forward because there's a lot more things, a lot more capital requirements coming up. And we always thought the most interesting opportunity to consolidate and potentially acquire is on the B2B side. Because as Drew talked about, so if you want to buy a retail broker today, it's actually very complicated. But on the B2B side, I think there's a huge opportunity to actually consolidate with technology on the prime side, clearly, because it's a lot about balance sheet, and balance sheet is one of these game changers. And frankly, from our side, you know, we came out in 2015 and said we think there's a consolidation happening. We'd always already built like a group structure where we have different entities, you know, a clearing entity that is very clearly doing clearing, a technology business doing that. So we've had kind of this experience of operating independent companies, but you know, to pull that off ourselves with private money was very difficult. So as part of that, we sought external capital to do that. And right now we see, of course, a major opportunity to consolidate on the B2B side, which is mostly about, you know, technology. But at the end of the day, the client is, and our clients are always going to be brokers or financial institutions. They're really concerned about costs. So the more you can kind of, in the end, squeeze the boxes, I think the more competitive you can be, and that's.
Okay.
I tend to agree with that. On the retail side, it's much easier nowadays to buy a book of clients, right? It's much easier than buying a company. You integrate them.
But are you seeing a lot of that taking place, though?
In peripheral countries, yes, you have offer here and there where you can look at that. But I think the real opportunities we have seen at ADS is people that come to us and say, you know, we have outgrown our credit in the market. We have this business plan. We are growing either because we manage clients' assets or we are in certain businesses, market making, etc. And you know, our prime brokers told us clearly this is the limit to what we will do for you. And they look at us as the ones that, you know, having much bigger lines in the market, we can help them grow. And you know, it's definitely happening more and more in that respect.
I want to go back to just Christian for a second. So yesterday, it was announced that Playtech was doing acquisition for, was it 40%? The numbers,
70%.
70% of CFH Group for a valuation of something like 100 million, or, you know, round off the pennies here and there. So what was what did they see in CFH Group that provided that type of premium? Because that was something like an 8x type of revenue.
I think the strategic questions are more important than the money question. I think at the end of the day, you know, we have had a strategy of wanting to kind of become bigger and doing that by partnering up with people, and clearly we couldn't do that ourselves. So we found somebody who really understood how to do that, and they've done that very, very successfully in the betting space. So I don't know how many people know about Playtech, but they're actually the biggest B2B player in the betting side, and we kind of had similar ideas about what will happen in this industry, and it's clearly about giving the end clients the products they want, but doing that from the most scalable way, and size just creates scale. So we saw an opportunity to strengthen the balance sheet overall, which is very important. So the CFH clearing business remains the same, no changes in that. The management team of the companies remain the same, the strategy remains the same, but we are just part of a much bigger entity, and I think for opportunities that gives us, it's just bigger, because we have more money to spend, we are under bigger balance sheet, and frankly, we now have people that also understand how would you execute a B2B consolidation strategy.
Okay, and you, so a year and a half ago or 2 years ago, you had announced that you wanted to also do this B2B acquisition structure. Is that still, are you still going to be looking to acquire other B2B companies?
Absolutely. I think CFH Group is and has been able to operate different entities, and they actually operate quite separately, but they do benefit from scale, and I think Playtech saw a vision that they thought made sense. You know, we have this group structure here, and we can potentially operate lots of different brands under that, and in total create a lot of scale.
Okay. So 4 years ago, when they had the first Finance Magnates panel, or it was Forex Magnates at the time, so one of the discussions happened to be whether it was worth it for companies to go public. There was a little bit of debate over there at the time. So I'm curious right now, not necessarily the public markets, but in just an investor appetite for Forex, binary, just trading in general. Start with you, Anthony. Like, are you seeing people still want to put money into this industry?
Well, I'm not
whether
looking to go public,
private
so-
or public? Well, yeah, but you have clients that you know how they're getting funded and whether they're looking for money or not.
To be honest, I think the S&B kind of changed the outlook on these brokers and and the investability. You know, with a lot of brokers, you know, obviously not being successful and making it through the event, I think that they look at it as more of a risk. I think that, you know, the S&B kind of opened the eyes to this increased leverage, you know, the increased risk, you know, what a GBP flash crash can do to some of these companies, or what the S&B can do to some companies. So I think that part of the step back was because they were looking at these entities a lot differently. I mean, prime brokerage for retail brokers dried up because they're looking at the credit risk. So I think that until the market kind of stabilizes, I think that you're going to see a lot of investors kind of staying away until everything kind of stabilizes.
Okay. And just Drew, since you've been in the market with a couple assets, what's the investor appetite you're seeing?
I think that if you look at the stuff that's hot, you know, like ECN, like Fast Match, you know, lots of demand, everybody wants it. You know, outside of that type of product, everything else, brokers nobody wants, you know, outside of very strategic stuff. I think FX in particular, you know, but all brokerage firms not in very high demand. And you have, you know, same thing, Anthony, you have the outlook on, you know, on the entire industry is extremely poor, you know, and I think that that's something where if you look at the alternatives, right, you can invest in other sectors of the economy and just get a much higher return, you know, and I think it's one of those things that our sector is not particularly attractive, and if you look at most of the financing that's coming for this sector and will come in the next few years, right, is going to be, you know, private individuals, you know, an esoteric, you know, capital that comes in and looks for something, but it is not going to be professional money, and I think that that's something that's going to have to, a lot of things have to change for that to be the case.
But do you think is that a 10-year type of thing where just the profit margins are just not going to be here? Or?
Greed doesn't take 10 years to come back. It's just purely a question of, you know, it's sort of, you know, real estate is back, right? And if you look at real estate in the Western world, like in the U.S. and the UK.
That's a yield on the interest on real estate versus a negative yield on your savings. So that's a play.
Well, but it's not just that. It's an issue purely of, you know, where, you know, if we have a string of big successes, it's obviously going to bring investors back. It's all a question of, you know, if somebody thinks the train's leaving the station without them, they're going to jump. If somebody thinks the train is stuck in a station, they're going to wait infinitely there. And I think that's something. You can see, for example, I mean, I can tell you, for us, you know, God bless the Donald, we had our best week ever last week, I think in 5 years or something. For those who didn't vote the right way.
Make FXCM great again.
I
think
But it's gonna
you have
have
to be
to
wearing
be
Tom's red jacket there.
right. I told him I don't have the, I don't have the guts to do what he did, but it should be but if you look at those, at that, if vol comes back that way for 2 years, earnings out of this industry are going to be phenomenal. Investors come back in
So
droves.
basically, investors are just chasing where the
Of
hot
course
markets
they
are.
are.
It's not-
Investors are like our clients, right? They're chasing our clients come back. When the markets are dead, people close their accounts because they're bored. When the markets are alive, accounts come back. It's not just the earnings come back, accounts come back, right? If you look at the history of FXCM, this is now almost 17 years. I can tell you 70% of all closed accounts come back when volatility happens,
Okay.
right?
Was it 17 or 70?
7-0.
7-0.
Right? I mean, it's a question of, people like to say, oh, people lose their money and go away. If you don't treat them badly, right, I don't think you purposely did it. I think it's one of those things that people do come back as people are chasing action, like all investors are chasing
Sure.
action.
So to get Mark, as other publicly listed member here on the
Well, we have 100%.
so what do you?
When you have a client actually as a bank, you keep him forever until he dies. So
In terms of your when you're doing your quarterly or half year investor presentations, what's the feedback you're getting? Is there
it's
less interest, more interest lately, or?
Well, this obviously, still a lot of interest and it's an important part of our revenue. It's about let's say about 50% now of the leveraged forex business and CFDs of the. Going back to M&A, we looked at many files, and we're still looking at because before we have cash, and we still want to grow unorganically. However, I have to say, and related to what you said before, it's for us as a bank, it's difficult to buy any type of clients. It has to fit with the regulatory environment in Switzerland. This is one thing. The other thing is the interesting cases we have seen in the market are all linked with technology. Suddenly fintechs has become very trendy. There's a new shift. There's a disruption now and I think many moves are going that way. But as you said, it may come back as soon as this industry is making more money. You will see those M&A happen again.
Yeah, and there's certainly an awful lot of interest from investors into fintech, and we get called all the time. At the moment, everybody wants to do blockchain. They don't know what it is. It's the sort of emperor's clothes, really. They have no idea what it is, but they think they should put money into it. It'll be something exciting at some point, but they're not sure what it is yet. But no, that's really interesting because it's...
What specifically are they calling you about? To create a blockchain, or they want to get your feedback on it, or find out if Goldeye is a blockchain company?
They're not normally calling us about blockchain, actually, because we don't do anything there yet. But obviously we will be, obviously. But no, they're just calling us because they know that we've got an awful lot of clients in this space and they see our name everywhere. And they want to be part of the action, and they see a tech play as interesting because you can get a higher return. It's easier, it's a cookie cutter thing. You make it once, you can sell it hundreds of times without doing anything. It's lower risk. So that's why they particularly want to get interested in it. And yeah, the calls do keep coming.
You mentioned that it's become a lot harder lately with prime brokers closing different accounts. So I want to, in terms of what's become like the best method now for brokers, if you can't get an account with a prime broker, how what other means to be doing it?
Advanced markets.
ADS, FXCM, I'm sure they're right.
Well, I think that prime brokerage obviously has dried up for a reason. It's risk, and I think that when you're looking for a broker.
Is it just, what do you mean it's risk? There's not money there. There's not risk for reward, or
Well, they look at the retail space.
or they
look
just
at the
can't
retail
have that on their
brokers.
balance sheets.
When you're given 400-to-1 leverage and you're given 200-to-1 leverage, the prime brokerages, they don't come and just look at me. When we were going through adding additional PBs, they don't look at me, they look at my clients as well. They want to see, well, what type of damage could be done by my clients trading with me. And so when you're giving high leverage and to the point where we have the situation where we were prepared for Brexit, we were prepared for the U.S. election. I think that you had time to change leverage and be prepared. In the flash crash, in the S&B, there was no time to prepare, and leverages were certainly more generous then. So I think the industry as a whole has to kind of look at being more conservative most of the time, more of the time, to prevent these situations from happening. And when you're looking for prime brokerage, that's the number one thing that they're looking at. They're looking to see if you're giving too much risk. I mean, the margins I pay at UBS, I could never offer my clients. I wouldn't have a single client. So you have to find a balance in between. Well, you know, I have to satisfy my margin requirements of my prime broker, but I also have to be able to compete in the market space.
So you're saying what, to like open up an account with someone who's already aggregating it, who's already doing that for you, and then you can get a higher leverage from that? Is that what you're leading to?
Well, I'm saying that, you know what, the industry itself has to kind of check itself a little bit and say, listen, we have to learn to be more conservative. And if you want prime brokerage, you're going to have to obviously build a balance sheet, but also run your business in a way that they see as being, you know, more conservative and more astute. And so in order to even the prime brokers like myself, you know, we also have to look at our clients that way too. We can't give leverage to clients that's you know, that maybe some of the other brokers can. You know, we're a 100% agency model, so every position that our clients do is at our PB. And so it's really important that we make sure that we have enough margin from our clients to cover their trading as well.
Okay. Mark, are you saying the same thing, that there's a shift towards you because companies can?
Well, first of all, there's different types of prime models out there. The way we have positioned our product is very much of a pure prime brokerage product, where clients come in with their own liquidity and we just take their trades and pass them on to our own prime broker. The key thing in building a portfolio of clients is on the institutional side, if they're pure institutional player, they're not retail brokers themselves, the balancing the portfolio of clients is critical, because yes, you can offer them competitive margin. I wouldn't say that today competitive margin means pricing below what my prime broker prices me. It means pricing them below what my prime broker would price them, which is critical, because my prime broker doesn't want them, and even if they send them a proposal, that proposal is prohibitive from a business continuity point of view. So I can extend my same margining and be flat, or I can be, you know, even more conservative and still be competitive with clients. The critical thing is to have a portfolio of clients that matches off. And you know, if you have, you know, 10 clients and they're all exactly the same business model and they add up exposure, you end up clogging up your lines with your prime brokers. And these lines used to be considered almost unlimited, in the sense that if you have a good standing with your prime broker, you have the cash or, you know, the collateral to post with them, lines keeps on growing. That has finished. You know, every prime broker has set a limit and you become too big for them. And having a set of prime brokers with whom you distribute your business becomes more and more important.
Okay, now I know there's been quite a few non-bank liquidity providers that have actually been in the market for a while, so there's some new entrants, but also some other ones that become larger. How has that affected, just in terms of liquidity quality? Not just getting quotes, but just liquidity quality.
I think that if you look, there's all kinds of HFTs, and we shouldn't lump them, the non-bank market makers, as one group. And there's ones that have increased the quality of, you know, the markets pretty significantly, and I think the ones that are more kind of speed demons and do less of that. But even those have a role in terms of taking liquidity that nobody else can handle and they can handle. So I think that overall it's been a massive positive, you know, for the market. HFTs have been really good. I think the one downside in this whole thing is HFTs have taken so much market share. I can tell you in our retail pool of clients, I think HFTs, we have 11 banks, 5 HFTs. 5 HFTs collectively win about 75% of the business. If you look at...
How does that affect your relationship with banks when they're taking...
Yeah, so what happens in the problematic element of that is the HFTs don't give credit, right? And while they give a great price and, you know, we do better by our customers because of it, and the rejections are less and all the metrics are better. But I think what happens is, as you know, as Marco was saying, I think as the banks have essentially capped everything and credit is scarce, it's definitely a return on equity for banks too. So banks are looking at life as how much money do I make from the credit I'm giving, and as we take volume away from them, it's less worthwhile for them to give credit. And I think that one of the things to be aware of is that I would say 3-4 years ago, if you were a big broker, you could have 20 friends as liquidity providers, 30 friends, make everybody happy. Even the guys weren't that happy. You could say, well, stick around, you'll be happier next week if you get better. Today, you have to pick your friends more carefully. You have to have less friends. You know, you have to do, because you have to give the people that are gonna stand by you a lot more business on an ongoing basis, or else they're not gonna stand by you. And I can say, you know, from experience, that when the shit hits the fan, you need to have friends, or you're not going to sit on this panel anymore. And so it's due to having friends that I'm here, and I think that while we don't do a perfect job doing this, I think this is one of those things that is very critical. And a lot of people don't do well. They spread their business too thin. And we all have, if you look at the cost of regulation, cost of capital is up 5-fold in the last few years. Right? People shouldn't kid themselves that that's the case. And we have fired clients, and everyone has fired clients for essentially the return being too poor. And I think people do themselves a disservice spreading their business too thin.
I want to widen out a little bit and talk a little bit about
If you don't mind a comment
okay.
on this one, I totally agree with Drew. I think the role of the non-bank liquidity providers is becoming critical. We have seen it on the flash crash. We did an analysis of who stayed there pricing us as the thing happened, and the people that you would expect there because they have the broadest shoulders, etc., were the first to run away from everything. And the only people left there were pretty much, you know, the non-bank liquidity providers. The problem we have with that model, though, is that clearly, as Drew pointed out, they are in competition to some extent with the same people their lives depends on, because you know, at the end of the day, we can discuss as much as we want about quality of liquidity, sustainability of liquidity, etc. But once you are not a bank, you can only provide that liquidity because a bank allows you to use their services to access the settlement system and so on and so forth. The moment that the banks will decide that this is against their interest because you are competing with them in many other aspects, and they pull that plug, that liquidity disappears. So, you know, they're helpful now. The question is, their survival doesn't depend on their own skills and their own business models, but depends on the goodwill of somebody else, which is a problem.
Just want to move on. Quickly, you mentioned that there's Christian mentioned that there's some premiums for technology companies. Just quickly, just want to hear what everybody thinks. Is there any specific type of technology, you don't have to say any names of companies, that you believe are like really important for the industry going forward? Just starting with you, Marco.
Yeah, I think risk management for sure, and cheaper connectivity. Okay. So somebody that comes in and disrupt the market for all the way to distribute liquidity.
Okay. Yes, I think everything you said, but still user interface is still it's not finished yet. You know, it's technology is moving on, and there will be faster new systems coming to the market.
I am against the philosophy of the silver bullet technology. I think since the dawn of MT4, we don't have silver bullets, and everyone's quest for the silver bullets is, you know, charging the windmills, you know, helplessly. This is a battle that technology is critically important, but people are kidding themselves they're going to come out with a new feature and that's going to make all the difference. And I think that this is something, the technology that matters is every piece of from onboarding to trading, from the interface to the back end, is you've got to improve that and got to keep going. But there is no silver bullet, not one.
I've always liked the front-end space because I think that's kind of what drives the clients to have interest in the first place. So unless you have clients keep coming back to the space, there's nothing else that kind of matters. So I think there's lots of things happening in the mobile space. For the first time, lots of brokers are announcing that actually they see tremendous, not just orders hanging on mobiles, but actually people trading. So I think there's there's a lot of stuff happening there, which hopefully will keep evolving to bring more people into the industry. So I think the front end space is still remains very interesting.
And I completely disagree with Christian on that one, because all my career has been in exchanges and places where the back-end systems have been the most critical, because you can't provide the front-end systems unless you've got really, really strong back-end systems. So my view would be really advanced liquidity management systems at a significantly lower cost than those that you can buy today is a bit of a game changer, and coupled with that, obviously, risk management.
Yeah, I agree with Tom. To me, it's connectivity. It's speed of connectivity. It's being able to get the bank rates to the client back to the bank as fast as you can and as accurately as you can. To me, being really just a outsource of liquidity, that's the most important component to me.
Okay, so just one last question before we take questions from the audience. So 4 years ago, going back to that panel, so the CEO of Saxo Bank was talking about MetaTrader 4, talking about the silver bullet. There's a discussion whether we're going to see MetaTrader 5 ever take off, and I believe Saxo Bank said, you know what, we were behind on MT4, but we want to be there for MT5. So 4 years later, at this point, we know MetaQuotes is very much pushing MT5 to their clients. Do you have any quick takes of, do you believe this is going to be something that's going to catch on, not catch on, or?
On our side, we are looking at it very closely, and we are working on it. Whether it will catch on and we will do it or not is still debatable for us, but it's one of the things we are looking at very carefully.
Okay.
Sooner or later it will. So MT5 will work. You just have to be ready.
Same thing. It's inevitability. People kidding themselves. It isn't. Just because MT4 is dominant, they'll make everybody upgrade. And I think it's a better system, MT5, and it will inevitably, outside of the EA compatibility, it is a much, much better system. There's no reason why it wouldn't replace MT4.
I agree. I think we are seeing more, maybe not direct client demand for it on, I guess, downstream all the way to the brokers, but I think there's more talks about it. I think more people are doing it, and it has to start somewhere. So I think it is happening.
Yeah, I mean, we've got a good take on this because we speak to so many brokers. And it's a little bit chicken and egg. The brokers are saying we're not going to do it because our clients aren't asking for it. The brokers are also saying we haven't got the technology, the add-ons, the third-party vendors like us to provide the components to do it. That's all now coming together. So now that we have the components, now they've added the hedging into MT5, and I'm sure at some point they will end of life MT4 so that people will be forced to move, because that's what you would normally do with the technology to make it move on, is you turn off the old one. It definitely will happen. A couple of years though.
We're platform agnostic, but we are getting much more requests for MT5 now than we ever have. So we're happy to connect to whoever's looking to use it.
So it's not a 4-year plan anymore. It could be a 1 or 2 year plan until we see more market share. All right, Jonathan, let's take it over for questions. Any questions from the audience? No.
Hi, my name is Yuri. I'm from Admiral Markets. I think that we've been talking about flash crashes, we've been talking about different events, technology, speed, and so forth. But in my opinion, we're just choosing an umbrella for the little rain. But I would agree with Drew here. I think the storm is coming, and the storm is coming from regulators. One way or another, I see that every year they sit down and they say, well, the retail clients are losing money, and we are getting richer. So how about we increase leverage? How do we increase and bring more regulation to the ballgame? So the question I have is, if you draw the dots, in regulatory development, then eventually you see it's not going to get easier. Is the industry going to exist in 4 to 5 years? What do you think? And if it will, then how many players and how many of you will be joining in the panel 5 years from now? And well, if it's not going to exist, then after all, we're all in the business. We have a lot of infrastructure, technologies, etc. What do you think would be potentially a new service or a new product that we can sell worldwide?
It's a pretty in-depth question there. You want to take a shot at that?
I will say that I've said
His
on
career and
panels-
company is lying on your answer here. So
Yeah. I will say on that, I've said before on panels like this that there is no question that that element of that there is a broad swath of people not just making money and cheering on customer losses as their sole way of making money. That is unsustainable from a government perspective. And there is no Donald Trump or anybody else that's going to save that business plan, right? That business plan's a great business plan, been there, done it, right? I am not judging. I am just saying that it is, I have more t-shirts than most of the people in this room combined on that business. It's more, it is not a business, right, that's sustainable. It just isn't, okay? And I think this is something that, you know, we've gotten away with it, right, as an industry for a long time, primarily in loophole jurisdictions, but not just. And I think that this is something that, you know, if we don't straighten out as an industry, there is no future, you know, to it, right? I think that's something that's going to get shut down for sure. Nobody can save it. I do think, though, that there's been enormous amount of change in the industry, and we do have a lot of good players. And I think this is something where we still make the bulk of our money comes from transactions, right? And I think that this is something that people need to get to, because this is something that's more easily defensible, especially in a more rational environment. And I think we're going to enter, you know, with the U.S. Elections, we're going to enter into a more rational business environment. And if we take advantage of that, right, and we kind of do proactive changes here, you know, as an industry group, I think those players will survive, and the players that don't do it will make more money in the short run, but will not survive.
Yes. To say it in one word, I think we have to self-regulate ourselves, or someone else will do it. Look what's happening in Belgium.
any more questions? Take one more.
Hi, Ed Anderson from FX Pro. I have my own particular perspective on this, but I'd like to hear from the panelists. Binary options, good, bad, indifferent.
I think talking about self-regulation and all this stuff, I think binary options has been one of these things where the regulators really don't like it. It's seen as a I wouldn't say absurd product, but really, really high-end gambling product, and it's had a lot of criticism. So I think we've never supported it. You know, we haven't seen support for it, and it's not a product we do.
Well, we don't offer it either, but I think it opens up a different type of question about who the regulator thinks they are regulating relative to what the user of binary option is buying. You know, because if the regulator is there to protect an investor, and the investor doesn't consider themselves an investor but a betting party, there is a mismatch between the two. And that's where lots of this misunderstanding happens.
You also have a quick answer?
Yes, I think whether we like it or not, I mean, it has a bad reputation, and this will not change overnight. So it's, I think maybe it's less on the product side, on the way actually those products are sold to the market, and I think it's bad from that perspective, and it's just impossible to change that focus, and we're not in that business, and there's no way of going into that business.
Is what matters, right? That if you're doing a binary option for a day, you can hedge that. That's a real product that has can be potentially even an institutional product. If you're doing a binary option for 60 seconds, there's no way to hedge it. That is binary, forgive the pun, in a sense that if your client makes money, you lose, and vice versa. There's no way that survives regulation.
I was talking to, when I was at the Israel conference, I was talking to some market affiliates, I think, and their job was selling. And the thing that upset me was the lack of education of the people buying the products. They just didn't know what they were buying, and they were almost buying something they thought could change their lives and make them very rich, whereas in fact the maths, as we know, is the other way around.
Anthony, yes, no? You're agnostic.
I don't,
Deal
we
with
don't
it,
support
don't
it.
think about it. All right, so I want to end out with some flash, use the word flash questions over here. Just on a scale of 1 to 10 of what you guys are worried about, from 1 being not at all to 10 being staying up at night for numerous nights. Just give a number. So let's start with MiFID II coming on. Sorry, Mark.
7.
That's conservative.
No, I think for us, it
No, you
has
you could do a rapid answer. I want to go around the room because we want to finish up here. Mark.
9.
12.
12.
1, because it's an opportunity.
10.
Okay. My firm does compliance, so we like having we like as many 10s as possible. But also, the question about binary options has raised a good point. How much are you worried about all that negative, really just binary options, even on a lot of the aggressive forex marketing that's going on? Does that start with you this time, Anthony? Is that worry 1 to 10?
Again, it goes back to the question we had before about the negative aura of the industry and how the perception is. So yeah, it's a problem.
I think it's positive, actually, because you can say that this is a cleaner market.
I think binary options potentially is one of these things that the regulators looked at in Belgium and France as well. And they tend to lump, because they don't really understand it, so they tend to lump.
But do you
all-
worry about all the negative headlines?
Yeah,
That
I
it doesn't
think
affect your...
Clearly, regulation is one of the key factors in this industry, whether it's going to grow or not in the future. So I think regulation is...
Okay.
There's going to be 10 more Belgiums because of binary options. So it's 10,
10,
12.
okay. Mark.
Yeah, it comes to the fact that we need strong regulator. I mean, that's a little bit the point. It's a strong regulator not only is protecting the clients, but is also protecting the industry. And I think and that's a little bit the problem. You have so many different places, so many different regulations. That's the issue.
I think 10 in Europe. For the UK, we have that strong regulator. We had meetings with them, and they're trying to balance that, protecting the industry and protecting the consumer. They understand the way the company that they regulate operate, and they trust in that. Of course, they supervise that. The problem is that in the rest of Europe, probably there is a disconnect between the players and the regulators in understanding exactly the industry. And therefore, they become very draconian.
Okay, so it's time to wrap up. Just some takeaways that we should be heading home from this panel. So Drew Neve believes that Donald Trump is going to save the industry, at least lowering regulation in the U.S. On top of that, that's going to lead to some, Anthony believes it's going to have some more entrepreneurs getting into more funding taking place there. Tom believes that risk management and a lot of the broker-based technology is what's going to lead the way. Well, Mark he said the UX is an important item that all brokers have to have in mind. You have to have the front end, not necessarily the back end. While Christian is a big believer in B2B, the premiums of B2B technology. So if you're a fintech company doing that, now's a good time to be looking for investors. And Mark also believes that technology is a way that's going to be differentiating companies in the future. And thank you very much. Thanks to all the panelists.